Hi folks, welcome to Tax Planning on the Whiteboard. I'm Jeff Montgomery. Today we're going to talk about long-term capital gains tax brackets, specifically the 3 tax brackets. I find that there's some confusion regarding these brackets, especially when we add some other income into the mix like ordinary income. A quick disclaimer here, this is not specific to anyone's personal circumstance. Please do not enact any strategies that you hear on today's episode without first consulting your tax professional or your financial professional. Let's just think of this as general information and education only. Now let's get to the whiteboard. Okay, on our whiteboard presentation today, the first thing I just want to talk about is the different filing statuses that we can file as a person, as an individual. There's really 5 different statuses. One is single, so if you're single, of course you're going to file single. Another one is married filing jointly. Well, we also have another one if you're a married couple. It's called married filing separately. We also have head of household filing status and qualifying widower. So there's 5 different statuses to file depending on your personal circumstance. On today's episode, we're going to focus on married filing jointly. In our first example, we're going to kind of keep things relatively simple. So we're going to say we have a married filing jointly couple and their ages, they're in their 50s, okay? And we're going to say that they have no other ordinary income. So no ordinary income from things like wages, okay? We're just going to say all they have is capital gains, just to keep this example very simple. And then let's say that they have a $600,000 long-term capital gain in the tax year of 2022, because we're going to look at tax brackets for this tax year 2022 as I am recording this. So $600,000 long-term capital gain. I know that sounds like a lot. Maybe they sold a highly appreciated stock. Maybe they sold a rental property that they owned. Who knows what the situation is? For this example, it really doesn't matter. Let's just assume there's a $600,000 long-term capital gain for a married filing joint couple in their 50s. Now, don't forget, we can apply deductions to this amount. Deductions also apply to capital gains. Now, normally they go to ordinary income first, but in our example, we don't have ordinary income. So right now, this couple has a standard deduction. We're going to assume that they don't itemize. They have a standard deduction of $25,900, okay? So what does that put their adjusted gross income or their taxable, in other words, not their adjusted gross income, their taxable income in this situation? So taxable income after the standard deduction is $574,100. $574,100. Okay, does that make sense? Let's rewrite that. $574,100. So that's going to be what we're going to use that amount and apply the capital gains brackets to that amount. So the first thing we'll notice is that we have capital gains brackets, and we have 3 of them. We have a 0%, a 15%, and a 20%. Again, on this chart, you see above those numbers, married filing jointly, you see ordinary income tax brackets. We're going to set that aside for a second because we have no ordinary income here. So the first $83,350 from 0 to $83,50 is taxed at 0%, right? Pretty good. So we know that we owe $0 on the first $83,350 of this capital gain. Now the next bracket spans $83,351 all the way up to $517,200 for a married filing jointly couple, and that's taxed at 15%. So if you do the math, the difference in that bracket is $433,850. that's taxed at 15%. So if we do the math, we take 43,850 times 15%. We have a tax bill. I'm going to round up to the nearest dollar, folks. We have a tax bill of 65,078 on that chunk of money, if you will. Now, we still have money left over that is going to fall into the 20% tax bracket. How much do we have left over? Well, we have $56,900 that is going to fall into the 20% tax bracket. So if we take the 56,900 times 20%, that is an additional $11,380. So our total tax bill, just considering long-term capital gains here, is $65,078. So we have $76,458 in long-term capital gains. Now, we are not going to do the calculation or talk about what is called the surtax or the Obamacare tax, the extra 3.8%. And we're also not going to talk about state taxes or state capital gains taxes in this video. But just kind of a quick idea, that's not your, in this example of $600,000, you're going to owe roughly an additional $13,300 in Medicare surtax. That's that 3.8% net tax, net investment income tax, on top of that $76,458. So just kind of keep that in mind if you have a large capital gain, or really any other income for that matter. So that is a pretty simple explanation of how just looking at capital gains works. What if we add to the mix where we have some ordinary income added to this? So let's go ahead and erase. Let's go ahead and erase our items here. And what we're going to do is we're going to look at a second example here of adding ordinary income to the mix. So in our next example, we're going to stick with the married filing jointly couple. So married filing jointly. And we're going to add some different types of income. So specifically ordinary income. So what we're going to say, married filing jointly, again, we're going to say age is in their 50s. We're going to say that they have $100,000 of ordinary income. So we can just call it wages. $100,000 of ordinary income and plus $100,000 of long-term capital gains. Okay? So we have a total income here, adjusted gross income of $200,000, right? Now don't forget, we still have a standard deduction or itemized deduction that we can take from that. So let's assume they do the standard deduction of $25,900 standard deduction, and that's going to leave us $174,100 in taxable income. Now, this gets confusing when you're mixing two types of income together, ordinary income and taxable income. And the first set of rules that we really need to do is apply ordinary income tax brackets first. So step number one is, let's go ahead to our chart here, married filing jointly, and apply the ordinary income tax brackets before we calculate the long-term capital gains. Now remember, $100,000 of this is long-term capital gains. So our remaining ordinary income amount after deductions is $74,100. So our first $20,550, we can see that right here, is taxed at 10%. So we have $2,055 in taxes on the first tax bracket chunk of money, if you will. Now, we still have some money left over that's going to go into the next highest tax bracket. So from $20,551 up to $83,550, we are in the 12% tax bracket. So if we take a look at that, That is $53,550 remaining out of our $74,100 falls into the 12% tax bracket. So that comes to a total tax of $6,426. So that is our ordinary income tax. Okay? So if we add those two together, we got $2,055 plus $6,426. We have ordinary income taxes of $8,481. But we are not done at this point. Don't forget, we have long-term capital gains of $100,000 in this example that I gave you. We have to apply long-term capital gains tax brackets on top of that. And this is where I find some confusion, because long-term capital gains are not taxed as ordinary income. They have their own set of tax brackets, as we can see right here. So how do we apply that when we also have ordinary income? And the IRS kind of throws a curveball in here, because what we have to do is stack long-term capital gains on top of our other income to calculate this correctly. So the second step is we're going to do some stacking techniques. So we're going to take the $100,000 of long-term capital gains, which is not taxed as ordinary income again, and we're going to apply that to our equation. So there's really kind of two ways to calculate this. You could take the remaining amount, let's just say it's $74,100, which is what, after the capital gains is separated, right? We have taxable income of $74,100, and we say, okay, we have some room until we get up to that first capital gains rate of $83,350, and that is about $9,250. So doing that math, $9,250 of the capital gain is taxed at 0%. So that is $0. Now, that can get confusing for some because we're stacking these two incomes on top of each other. That's one way to calculate it. So that leaves us $90,750 of long-term gains that is going to be taxed at the next bracket. And that next bracket is 15%. Okay, so $97.50 times 15%, that gives us $13,612 in long-term capital gains. That's one way to calculate it. Let's show you a different way, maybe a little bit easier way to figure this out. What if we just say, you know what? We know that stacking our income, the first $83,350 as capital gains is taxed at 0%. So let's take our total taxable income. We're going to take $174,100. Let's subtract that 0% tax bracket. Subtract $83,350. That leaves us with, guess what? The same amount, $90,750 remaining. That remaining amount must be taxed at the long-term capital gain rate. That long-term capital gain rate in this example happens to be 15%, again, for $13,612. So if we look at our total tax bill in this example, we're going to have $13,612, and we're going to add the $84.81, round numbers here. Our total tax bill in this example is $22,093. Okay? And kind of do the math. If you look at that, we had a $200,000 adjustable gross income, $100,000 ordinary income, $100,000 capital gains. We paid $22,000 total in taxes. So that's what? 11% effective tax rate in this example. Okay? I hope that makes sense. Please reach out if you have any questions on this. I'd be glad to discuss this with you. But hopefully that clears some things up. And again, please join us for the next episode of Tax Planning on the Whiteboard. And if you like these videos, don't forget to hit subscribe. I'm Jeff Montgomery. I'll see you next time.